Hey, what's going on, everyone? It's Will Shank here, and in this video, we're going to talk about 2016 United States tax strategy. I'm going to try to keep this to about 30 to 40 minutes. I'm going to cover a bunch of different suggestions for you to drastically reduce your taxes. Full disclosure, most of these tactics you're going to need to implement for the 2016 tax year. You can't just retroactively use a lot of this stuff. But overall, you should be able to save a lot of money, and I'm really hoping to present some stuff you probably haven't heard anywhere else. So first and foremost, here's a light agenda. We're going to go through a disclaimer. Basically, I'm going to tell you I'm not a professional accountant. Then we're going to go over a few brief understandings of tax theory in general. We're going to talk about your business structure. We're going to lightly talk about write-offs. Most business owners are typically pretty good at them. Then we're going to talk about buying a car. CEOs love cars. So yeah, I'm going to show you 4 different ways that you can buy a car within your company. We're going to talk about a couple deductions that you can only do if you're a CEO. We're going to talk about healthcare because a lot of stuff has changed with that in the last year or two. We're going to talk about a couple mindsets, and then we're going to bring it all together with a couple very made-up case studies. So first and foremost, again, I'm Will Shank. I do have some past experience in the tax world. But I was a financial planner. I wasn't an accountant. So I was a licensed financial planner and stockbroker for 2 years. Decided to go back. I got a master's in finance. Decided I really liked teaching. I became an adjunct college professor. At that level, I did teach accounting and managerial accounting. But I also got wrapped up in the Certified Financial Planner course. So basically what I did there is, in addition to teaching college kids, I taught financial planners with 5 to 25 years experience an advanced module for them to get an advanced certified financial planner certification, and I taught them federal income taxation and investments. So I'm not an accountant, but I've got some pretty solid understanding in this realm. So my main angle here is not to tell you how it is, but more so to give you a much broader understanding of the kind of write-offs and deductions and advanced tax strategy that's available to you as a business owner, and have you go and work your accountant harder. And it's not, every accountant's not going to come up to you and say, hey, did you think about this? A lot of them just take your return and do it. So with these kind of advanced tactics, now you can have better questions when you go see your accountant and say, hey, why aren't we doing this? Let's get this going. So without further ado, let's get some basic understandings here for different tax stuff. So first is I want to talk about tax rate versus effective tax rate. The amount you pay in taxes as a percentage is not whatever tax bracket you're in. The tax bracket you're in is how much you're going to save with each deduction until you drop down a tax bracket. So I'm over here. If I'm in the 39.6% tax bracket and I decide to go out and buy a car and write it off, then my car just became 39.6% cheaper. The percentage of actual taxes you pay out of your pocket versus how much you made that year, that's called your effective tax rate. That's ETR. Really, when you talk about like how much savings you have, that's what you want to look at, because that takes into effect everything. That takes, state. You can add in your Social Security or self-employment taxes, your federal taxes. If you're really a numbers Nazi, you can go and add in things like property taxes, sales taxes, all that kind of stuff, depending on how intricate your tax strategy is. But yeah, just know that, let's say you made $500,000, you're not going to pay 39.6% of $500,000. What you're going to end up paying is more something like 28.7% or $144,000, I believe it is. So, and that's because you pay a lower percentage on, the first $75,000 you make, and then a lower percentage on the next 75,000, but slightly higher than the first 75. Yada yada yada. It's a bracket. Okay, another couple basic understandings you need to have is that the average person, I'm not even talking about a CEO, the average person pays taxes over 10 different ways. Federal income tax, that's going to be the largest portion of all your tax payment. State is going to vary widely. If you're in Nevada, if you're in Florida, if you're in Texas, or one of those awesome states, you're going to pay 0. If you're in one of the shitty states, like California, New York, you could pay 7, 8, 9, all the way up to 13%. Payroll taxes is going to be a big portion for employees. Payroll taxes 7.65%. So what happens as an employer, you have to pay that for your employee, and then they also match that. However, because you're also your own employee within your company, for yourself, that's going to get doubled. So instead of 7.65%, you get the quote unquote self-employment tax, which is 15.3%. Social Security, Medicare, it sucks. And then also random taxes you're going to pay throughout the year: property tax, sales tax, gas, luxury goods, like if you got a boat in certain states, or federally if it's a real big boat, utilities, special use, cigarettes, booze, guns, car registrations, tolls, yada yada. So long and the short, you already know this, we pay a shit ton of tax. So lastly is it can really add up. So let's say you're married, you make 500K, you live in California, you're in the 39% tax bracket. You know, you're at the highest state tax bracket, you pay 15.3% of self-employment tax. You know, if you add those up, it's 68.2%. Don't worry, you're not really paying that. You're paying more like 46%, which is 230K, and that is a crap ton of money. And then in addition to that, you're going to pay property tax, you're going to pay sales tax, and now we're looking at 50%-ish, and that really sucks. So basically today we're going to talk about how to a bunch of different ways to mitigate that out. So the first two things you can do can have probably some of the largest impacts on how much tax you're going to pay without having to go and change how much money you're going to bring into your household. So the first one is moving. This is a wildly personal topic. You know, it's really naive for me to sit here and say, hey, just move to a cheaper state. You know, you have family, you have, you know, wives, you have fathers, mothers, all that kind of stuff. But a lot of entrepreneurs will move away for 6 months and a day, or the majority of the year. The benefit of that is they get taxed in the state where they live the majority of the year. Then the other, 5 months and 29 days, they go back to the state where they originally reside. Now, if you have kids and all that, obviously it's more complicated, might not work out for you, but for you guys who are just married or single, this is a really good option. So 7 awesome states where you have 0% tax at the state level: Florida, Texas, Washington, Wyoming, Nevada, Alaska, and South Dakota. There's a couple other states that have really low state tax. I know South Carolina's in there. There's a few other randoms I can't remember off the top of my head. But if you want to go and save 7 to 10% right off the top, move. So I live in New York State. It sucks. I pay out the butt for property tax. I pay out the butt for state tax. And I would, we're making it a priority to explore a couple different tax advantage states this year to have that big savings. Next, the other big thing that you could really do to shave a lot off the top is decide, do you want to continue to be an LLC or do you want to file as an S-Corp? For the majority of you, I would highly suggest you file as an S-Corp. And here's what that means. So an S-Corp is an LLC that elects Subchapter S. Basically what that means is by electing Subchapter S, you can take dividends. So if you're a regular LLC, the only way money comes out of your company is you pay out profits. Profits are then taxed at the federal level, the state level, and then you're going to pay your self-employment tax. However, if you're an S-Corp, you can pay profits, which pays all those, and you can get distributions, aka dividends. So this is just like a big, Fortune 500 company. They pay all the people who work for the Fortune 500 company, and then they pay the investors the dividend. So now you're both an employee, the owner, and an investor of your own company. The cool part about that is those distributions will not have to be taxed for your self-employment tax. So you're going to save your Social Security and your Medicare on your distributions, which is 15.3%, and that can really add up. So what you have to do here is, if you're an S-Corp, is you have to take a quote-unquote reasonable salary. Every accountant is going to define reasonable salary a little bit differently. There is no set rule. It's whatever's reasonable for a CEO in your industry at a company as profitable as your company, which is a bunch of hoopla saying, they don't really know, but if you're going to go crazy about it, the IRS is going to audit you. That's what that means. So if you make 500K, I would roughly, I wouldn't take any more in distributions than 250, 300,000. Rule of thumb is roughly 50%. But if you're getting into that insane range, where you're making $1 million a year, it's not unheard of for a CEO to only make $250,000 a year, in which you might be able to justify a much larger distribution and a much larger tax shelter. I don't want to have your eyes glaze over and roll in the back of your heads, but let's just do a really simple example. If you're an LLC, you make $500K, 15.3% of $500K, you're going to pay out $77,000 in payroll taxes. However, if you're an S Corp, let's say you take a $200,000 salary, it's a pretty good salary, and you take a $300,000 dividend, now you're only going to pay out $31K in self-employment tax. You're going to save your ass about $45,000. Pretty huge. So I save almost 30, yeah, right, 45. So for all of you guys out there, if you're not an S Corp, set up an S Corp. It really is in your best benefit. There are 2 drawbacks, and they're not even drawbacks. They're just additional pains in the asses. As an S Corp, you're going to have to do some additional reporting, some more reforms. So your accountant's going to do all that stuff, and you're going to pay your accountant a little bit more money at the end of the year. Also, you're going to have to set up a W-2, and to get a W-2, you need to be established with a payroll company. So basically what you're going to do is you're going to sign up through ADP, and every time ADP cuts your monthly, weekly, bi-weekly paycheck, however often you want to get paid, you're going to pay ADP or your payroll company, whoever it is, between $50 and $70. So that's going to add some overhead, but considering you can save $40,000, and to save $40,000 you have to spend $1,000 to $2,000 more, which, by the way, this $1,000 to $2,000 is also a tax write-off. I'd say it's a pretty smart, you don't have to think too hard of it on it kind of move. So if you're an LLC, I highly recommend you set up an S Corp. The only time where an S Corp is going to get additionally hairy is if you're looking to bring in a bunch of seed investors down the road. You might have to drop the S Corp down the road, or you have more than 50 people who own your company, which most of you guys probably aren't sitting in that boat. So yes, long and short, set up an S Corp. All right, so we covered the big 2 things that you can do to save a lot of money: move for 6 months and a day, set up an S Corp. Now let's talk about some of the little minutiae stuff. Write-off maximization. Basically, the first one is going to be your home office deduction. How they figure that out is they look at how big your home office is versus how big your house is. And let's say you have a 500 square foot home office, it's an absolutely monster office. You take up the entire basement of your home, and you have a 2,000 square foot home, then basically 500 over 2,000 is 25%. You can now write off 25% of your mortgage or rent. You can write off 25% of all your utility payments. You can write off 25% of your homeowner's insurance. And that's a nice little additional write-off that sometimes a lot of business owners are too lazy to sit there and figure out. Next, cell phone, internet, cable, office supplies. Common sense, cell phone and internet and cable, your accountant might go, oh, well, you can only write off half and all this. What I do is I write off the whole thing because the majority of my cell phone is used for my business, and I just don't say anything like, hey, here's my $100 cell phone bill for the business. Write it off. That's what you should tell your accountant. And internet and cable, I use 95% of it for my business. I don't really watch TV. If I do, I'm watching it in my home office, aka go and write it off that way. But that's all on your personal preference. If you want to be a little more squeaky clean, you can write off 50% of it. Next, other office supplies. Anything that's in your office is a write-off. So if you're using your bathroom, every 5th shopping trip, go and write off the toilet paper and some cleaning supplies. I have a mini fridge in my office. I stock it with beer and water and, decaffeinated sodas and stuff. There's an extra little write-off. That kind of stuff adds up. You get a couple extra $1,000 written off at the end of the year. It all counts. A couple $1,000 in food and all that, office snacks that you eat while you're working, bottles of wine that you drink while you're working, 6 packs of beer that you drink while you're working. $2,000 could end up saving you about $800 out of your pocket in actual tax money. So keep track of it. It's pretty worth it. Next, equipment. So we're talking about stuff, if you actually own a fulfillment center, you have some real equipment, shelves, maybe you have a small forklift or pull carts and all that kind of stuff. For the home office guys like myself, equipment is something you're going to have to make a distinction of. So we're talking about laptops, we're talking about monitors, printers, and if it's over $500 in 2015, these are important numbers to remember, or $1,500 in 2016, you have to depreciate it slowly over so many years. So if you go out and buy a $2,000 Alienware gamer computer, you don't get a $2,000 right off that year. It's going to be depreciated over 8 to 10 years. However, if last year you bought a $499 computer, it's 100% a write-off that year because it's under that $500 threshold. This year, 2016, guys, if you need to update your computers, that number is $1,500. So if you're going to set a computer budget for yourself, I would highly suggest make that $1,500 so you can expense it all in 2016. Next, office renovations. Hey, if you're rolling in it and you're in a high tax bracket, why not treat yourself? It's going to be a nice big tax write-off where you could save yourself 20, 30, 40, 50%. Eating out and entertainment. So a lot of people have weird connotations about this write-off. Here's what you need to do. If you're talking business with somebody who is in your business, get the receipt, write your name on it. It is a legit write-off. If you're worried like, oh, well, I have $1,000 of write-offs, don't sweat it. As long as you're profitable, you're probably not going to be, as long as you're profitable, and paying the same amount or more of taxes as you did last year, you're probably not going to be under the scrutiny of the IRS. I can't guarantee you that. No one will guarantee that. But, I don't want to coax you into being more aggressive than you have to be, but you really shouldn't be freaking out about it. To put it in perspective, we wrote off $3,000 or $4,000 of eating and entertainment last year, and because of the amount of income that we had, I flat out asked my accountant, hey, what would happen if we've written off more? And she looked at me and said, you're paying more taxes than you ever paid. I don't think the IRS is going to blink. But if the IRS does blink, just reiterate that you're in an information-based business. You have to do a lot of networking. It's the core of your business. And they're going to look at the rest of your business and say, oh, well, you don't have a lot of assets. You have a couple computers, this or that, and you pay a lot of taxes. They're probably not going to really dig into me at all. So that's straight from my accountant's mouth. I'm not telling you what you should do, but, there's my story. Take it how you will. Next. Oh, interesting thing is if you do not treat yourself to eating out on your business very often, perhaps you may want to think about saving it for when you go on business trips. Reason being is if you're in town, it's only a 50% write-off. So if you have a client, if big marketing guy from Texas comes up to wherever the hell you live, and you guys go out on the town, you go shoot guns at a gun range and go drinking for a night, and you rack up a $200 bill, you can only write off $100. However, if you go visit your Texas friend in his home state, you can write off all 200 of that, plus your airfare, plus the gas it took to drive there, plus your hotel, whatever you did to get there, and all the food and all the activities you did when you were in town, as long as you were on business. So there you go. So other than that, write-offs are pretty standard. Anything you have for your business, I'm not going to cover any more on it, with the exception of cars. Internet marketers love cars. You guys are all car dudes. So I'm going to talk about the 4 different ways your business can pay for a car, and you can figure out what is most appropriate for you. So the simplest way is the mileage deduction. So let me tell you when you're going to apply the mileage deduction. If you owned your car before your business owned your car, you have to take the mileage deduction. You have no choice. So, let's say you're a newer marketer, you've been in this a year or 2 years, you haven't gone out and bought that, dream car just yet, and you still have the same, Toyota RAV4 you did when you started the business. Well, guess what? You can't just all of a sudden, depreciate that car on your taxes and write off all the repairs and all that kind of stuff. Sorry, it doesn't work that way. The rule of thumb is you can never own the car before your business owns the car. Now, the business can own a car and sell it to you down the road. Totally cool. That works. But you can't own a car and then have the business. So if you're doing this, or if you have a shitty car, if it's a beater, if you're just not a car person, like I still drive a 98 Altima that's rusted out to hell and back. I'm definitely probably going to be upgrading this year, but I, in all sincerity, drive like 1,000 miles a year because I drive mostly motorcycles when it's warm out. So I just don't care. So for me, I take the mileage. So in 2015, it's 57.5 cents a mile. 2016, 54 cents. So if your car standards aren't as low as mine, but they aren't in the stratosphere, and you want to go out and buy a new car that isn't crazy expensive, we're not talking about a Tesla, we're not talking about a Mercedes, we're not even talking about an Audi. If you're going to go and buy a $10,000 used car that's respectable-ish, or maybe a $15,000 SUV, probably your best bet is going to be buying it and depreciating it. Depreciation for cars is really weird. You get like $3,100 the first year to write off. The second year, you write off $5,000. Every year after that, you write off $3,000. So you can't just buy a $15,000 used SUV and write off $15,000. It doesn't work that way. So let's say you buy an $8,000 car, you go and you buy a used Audi, something that's like 6-7 years old. Basically, that thing's going to depreciate out in 2 years. If you're making about the same next year, it's not really a big deal. However, if you have no idea if you're going to be in a lower tax bracket next year, you hope you're going to be a higher, but you don't know, then ideally you want everything depreciated out this year. Or let's say we bought a $25,000 car. That thing's going to take 7 years to fully depreciate. Big pain in the ass. The one big difference between mileage and these other three methods I'm about to tell you, which is buying, leasing, and a 179 deduction, is the one cool thing you can do is you write off all your gas, as long as it's for business, all your maintenance, your Easy Pass, your AAA membership, anything to do with the car insurance, all that stuff. Where in the mileage, all you get is the mileage. You don't write off the gas, you don't write off the repairs, you don't write off the insurance, AAA, any of that stuff. So buying, leasing, and the 179 deduction could be a lot more lucrative. So I saved the best for last. This right here is probably what's going to be exciting you guys. Leasing. Leasing is really great for expensive cars because you get to write off 100% of the lease payment. You get to write off the gas, the insurance, the repairs, the miscellaneous stuff. So let's say we go out and we lease a $100,000 Tesla, and that's $1,500 a month. Now, if we bought a Tesla, it would probably take us about 30 years, no joke, to fully depreciate our Tesla, if not a little bit more, because we're only depreciating $3,000 a year. It doesn't make any sense. However, if this is for business purposes, we're the CEO, this is the CEO's car just for business, you can go and, instead of buying it, let's say you lease the thing, $1,500 a month, $18,000 a year, or whatever the hell leases work out to be, you can now write off $18,000 a year versus $3,000 a year if you bought the thing. So pretty substantial difference. If you want something big, shiny, and crazy, and you might upgrade to that in 5-10 years. If you don't see this as being the car that you're going to own until you die, and you're probably going to be buried with this car, I would really consider leasing the damn thing. Lastly, and this is really, really cool, this is what I'm going to be doing this year, it's called a Section 179 deduction, aka accelerated depreciation. So this is a pretty cool loophole, and it very, very much is a loophole. Accelerated depreciation was originally put in place for large equipment. So we're talking about like tractors for a farm or big combines and stuff like that. But because they wrote the rules really loosely, a couple smart accountants figured out that they could use this 179 deduction for trucks and large SUVs because it stipulates that the piece of equipment needs to have so many feet of space in the bed, which for an SUV is how much space you'd have when you fold down all the seats, and it has to be so many pounds in weight. I think it's like 8,000 or 8,500 pounds. So not a lot of SUVs qualify for this, but the ones that do get some really insane tax treatment. So the really crazy thing about 179 deduction is that the rate changes every year. A few years back, the rate was set at, I believe it was $100,000 for vehicles, so you could go out and buy a brand new $100,000 Mercedes GL 450 or 550 and write off all $100,000 in that year. They've tightened up the reins, and this kind of fluctuates every year, and they don't really announce what the limit's going to be till about the end of the year. So if you're going to do this, and you want to go out and you want to buy a nice big truck, or if you want to buy an SUV, I would wait till about November, December, start asking your accountant, say, hey, we made a lot of money this year, I want to upgrade my car. In 2015, you could depreciate 100% of the first 25K. So if you went and bought a used Mercedes GL 450, got it 2 or 3 years old, or maybe more realistic, 4 or 5 years old, you could depreciate that $25,000 truck 100% that year. Now, what happens if you buy a $50,000 truck is the first $25,000 gets depreciated, accelerated, and then starting next year, you're going to do the $5,000 and then $3,000 after that until the full value is depreciated. So I really wouldn't go too much higher than $25,000. So this is really a smart move if you're a truck guy and you want a nice, $25,000, $30,000, maybe even $40,000 used truck. Or if you want a nice, 1 or 2 year old, 3-year-old, if you're going to go Mercedes, used large SUV, because these things do have to be big. So think Honda Pilot, Mercedes GL series, 450 or 550, 350s are too small. Highlanders, basically big ass SUVs. You can research online if it meets the criteria or not. But make sure to do your research. It would really suck if you bought an SUV that was, maybe you bought a Chevy Envoy and it wasn't big enough. And then now you got to appreciate that damn thing. Next, let's talk about deductions for CEOs only. So I pay really close attention here because this is where the really weird stuff happens, and you can shelter a shit ton of money. You guys all know about 401ks. You all know about IRAs. You contribute $5,500 401k. I believe it's like $1,700 this year. Actually, IRA might be $6,000 this year. Been out of the loop with that one for a while. But CEOs get a unique bundle of goods. Now, every accountant under the sun is going to say, oh yeah, you should set up a SEP. SEPs are easy. They're, you can set one up on E-Trade. They're pretty mindless. Which is basically it's an IRA where you can contribute more because you're a business owner. However, I would like to direct you towards a different kind of IRA or 401k for your business, and that's called a self-employed 401k. The reason I want to point you in this direction is because the limit is a crap ton higher. So a self-employed 401k, basically, you can contribute up to $53,000 or 25% of your revenue, whichever is smaller. So if you make $100,000, 25% of that is, I think I said 20, I meant to say 25% of your revenue, 25% of $100,000, 25 grand, you're going to max out there. But if you make $500,000, then you're going to hit that $53,000 limitation. So $53,000 is a pretty awesome write-off, and basically you're going to get a write-off now when your taxes are really high, just like when you retire down the road, you probably won't be making $500,000 a year in ordinary income every year, and you're going to pay a much lower tax rate. And also, maybe once you're old, you'll move to Florida. Now you don't have to pay state income taxes. And also, once you're old and retired, you're not going to be paying the same amount of Social Security taxes because those trail off with age once you hit retirement age. So, I would highly recommend setting up a self-employed 401k. It's super, super easy, and if you're making a lot of money and you're just sitting on cash, it's the quickest way to go and reduce down your taxable income. The other cool thing about this is the one thing, the only one thing that you can go and contribute to today and set this thing up today and reduce your tax liability for 2015. So if you're sitting on some cash, you've got a really big got a really big tax bill, go up and set up your self-employed 401k. Also, if you have a spouse that works with you that claimed income last year, the spouse also has the same limitation. So if your spouse made 100 grand, they can do up to $25,000. Or if you just split the profits down the middle, or however you want to work it out, that spouse can go and contribute up to 53 grand. So if you make a shit ton of money, you and your spouse are in it together, you can go and write off up to $106,000. Double check. The one thing I would ask your accountant, that off the top of my head, I know that it's 25%. I'm not sure if that's on the entire business, and the employee can match whatever you put in, and if it's matching on percentage or dollar basis. But I'm unsure as to if you only pay your wife $53,000, if she can write off all $53,000 if she goes and puts 100% of her paycheck into her retirement account. I would ask an accountant that. It might be worth looking into, because if you could, that's a pretty sick write-off. So that's just the one little fuzzy spot that if you do have a wife and you are trying to get really advanced, just double check before you do it. Another thing nobody talks about, that this is going to be an even bigger monster of a write-off, is called a defined contribution plan. So basically, these things were set up in the 1980s to be pension plans for medium-sized companies that have 50, 100, 500 people, and larger. And a lot of companies that were even larger set up these kind of things. So anyone who works at Bethlehem Steel or Ford or these old blue chip companies that went and paid their factory workers pensions, that is exactly what this plan is. However, some crafty accountants got in there and said, well, why can't this one guy who's only his own employee go and take advantage of this? So right out of the gate, if you guys have in-house employees, this is probably not going to be the tactic for you. Also, if you guys make anything less than 300, 400, 500 grand, this probably isn't worth even looking into just yet, because it does cost a fair deal of money to just maintain and administer this plan. But basically what it is if you want to set up a pension for yourself and you want to go and get a really big write-off, you can write off up to $206,000 in addition to your self-employed 401k every single year. Now, there's a couple pains in the ass here. One is you have to pay to get this thing administered. So you have to hire a special kind of financial planner and an actuary. The tab on that can run between $2,000 and $8,000 a year. So that right out the gate is a really large added expense, but for a $206,000 write-off, very well and very easily could be worth it. The other thing is there's some weird complications where you can't just not contribute next year. And the assumption with these plans is you're going to contribute every single year until it reaches a critical mass, and then you don't have to contribute anymore. And usually that critical mass is whatever you set the contribution to be up. I don't want to go too far down a rabbit hole, get you guys glazing over in the back of your head, but if you're rolling in dough, the moral of the story is get a really good financial planner who specializes in business owners and being financial planner to successful, wealthy, business-owning individuals, and say, hey, let's talk about self-employed 401k and defined contribution plans, because you can go and write off up to $300,000 with that, and that's a huge amount of tax savings. Next, healthcare. So healthcare gets a little tricky if you have employees, and if you have employees, probably you want to talk to somebody else. You're out of my scope. But if you're just getting healthcare for your family and you're the only employee of your business, or you and your wife are the employee of your business, you may want to change how you look at healthcare. So obviously you want to buy this through your business, and that's totally normal. A lot of people push business owners or suggest, hey, you should do a high deductible healthcare plan. Now, for a normal employee, high deductible healthcare plans for young couples or young individuals who are healthy make a lot of sense, because you get to set up an HSA, and an HSA allows you to save $6,000 a month on the side. And an HSA is kind of like an IRA. It's just money in a special account, but you can only use it for healthcare. And you can't do that with a normal healthcare plan. The downside of a high deductible plan is if you do go to the hospital or you do need prescriptions and all that stuff, that all comes out of your pocket, not your business's pocket. The only thing that ever comes out of the business's pocket is the premiums. So let's talk about if you're married and you have children, or if you're an individual who has particular healthcare needs that is more than a couple $1,000s a year, or if you and your spouse have, prescriptions, or you might be having a baby or have a surgery coming up or anything like that, it's going to make a lot more sense for you to pay more money out of the business with a normal healthcare plan than to get a high deductible plan, because everything that's paid out of the business is a write-off. So you would prefer to pay the higher amount in the business's name and then less amount in deductibles out of your money versus the other way around. Now, there's one additional thing you do to really reduce your health bill, and this is something no one else talks about. And that is going to be called a medical reimbursement plan. So a medical reimbursement plan is something you can set up for your employees where you can reimburse them for any out-of-pocket expenses they have. So here's the catch. As the business owner, you cannot set up one of these things for yourself. So you can't go and say, oh, well, I'm going to get a high deductible healthcare plan, and the first $5,000 that I have to pay out of my pocket, I'll just reimburse it out of the company for this medical reimbursement account. It doesn't work like that. However, kind of the workaround is what happens if you're married is you bring your spouse in as an employee and you yourself do not get healthcare through the company. What happens is your wife gets a healthcare plan as an employee for your company, and because you're married to her, you're covered with healthcare through your wife's plan and your children and whatever. And then because your wife is an employee of the company, you can set her up with a medical reimbursement account. And if you're getting reimbursed for everything, then a high deductible healthcare account really makes sense because all the premiums are paid for by the business. That's a write-off. Anything out of pocket is covered for your wife through your medical reimbursement expense account. So now we're writing off 100% of all medical bills. In addition to that, you can set up a health savings account. And anybody who has a high deductible plan, whether you have a medical reimbursement or not, you can set up a health savings account, which is basically like an IRA for medical expenses. Now, because 100% of your expenses are written off because you have a high deductible plan in your wife's name, because your wife's an employee, and she has the medical reimbursement expense account, you don't really need to write off any other medical expenses. So why would you have one? Well, the reason you have one is you can put $6,000 away that you don't pay any taxes on when you put it in. You don't pay any taxes on when you take it out. It's never, ever taxed. So basically here, you're saving for your healthcare costs for the future whenever you don't have a company anymore. It doesn't even have to be when you retire. If you sell the company in 5 years, all of a sudden you still don't have to pay for your healthcare out of your pocket because you have $30,000 stacked up in this health savings account. The other cool part is this can be invested to a certain degree so you can still earn a little money as it just sits there. And if you have your own company for 10, 15 years and you rack up 60, 90 grand slowly, when you do fully retire, you'll never pay for healthcare ever. So that's pretty cool. So those are all the advanced ways you can really go and save a lot of extra money. Probably the most unique that I talked about that are unique to you that you may have not thought about are going to be the different ways to buy a car. Probably going to be leasing or do a Section 179 deduction if you're looking for a large SUV. If you're looking to do beaters, you want to buy, or you could just take the mileage. Actually, if you've already owned the car, you're going to take the mileage no matter what. That's your only option. The other things that are going to be pretty unique about this call is you want to set up an S-Corp if you don't have one. That's just an absolute no-brainer. As long as you're going to save more than $1,000 or $2,000 a year, it's worth doing. Next, you want to think about, and I don't want to tell you to move, but you want to, possibly ponder the options of spending 6 months in one day in a tax-friendly state, even if it means owning 2 homes. Sometimes you can save so much in taxes, it'll pay for your summer home, and you can still own the home you live in now. Next is you want to look at and get a referral from your accountant and say, hey, I need a financial planner. You're going to be setting up a self-employed 401k. If you have a high tax bill for 2015 and you're sitting on some cash, go and make a contribution before April 15th. And I believe you have till around the end of March to get that thing set up in time. Also, if you want to go and save some money for 2016, go ahead and get that thing set up. Possibly look into getting it set up for your spouse too. And if you're really, really rolling in it, making some crazy money, you're going to want to also look at setting up a defined contribution plan. Lastly, you're going to want to get a referral from your accountant or your financial planner, and what you want is a healthcare broker. Your healthcare broker is going to help you find an awesome healthcare plan. He'll be the one who says, maybe a high deductible plan makes sense, maybe an HMO plan makes sense, and you can kind of break it down and say, hey, well, the business is paying for this, and that's a tax write-off, and I'm in a high bracket. So let's look at the HMO plan, or maybe you can also talk over the medical expense account plan, because those are not that much to administer, but very few people do it. So you're going to have to hunt around for somebody to get that plan set up, and you're also going to have to bring your spouse on an employee. So again, I really want to recommend bringing in a really, really above average, super competent financial planner who specializes in business owners. Because the financial planner will also have to weigh the pros and cons of bringing a spouse in as an employee to take advantage of this kind of healthcare write-off maneuverability, because it's a little bit complicated. So those are the basic, like, that's the path, is S corp, evaluate another state for the future. Think about how you want to write off your car, take all those write-off maximization things I talked about, your home office, all that kind of stuff. Find a financial planner, start socking that money away on the side, and then find a healthcare broker. There you go. So here, a couple advanced mindsets you always want to keep in the back of your head. Have the business pay for everything. Business always pays for everything. Anything you possibly can. Think of a way that you can make that experience, that whatever you're doing, that small asset, be a business asset, be a business experience. Hey, all I can say is it's really good to have your friends in the same business as you are. Everything gets written off, where if I hang out with my friends from high school, that's all coming out of my pocket. Next, treat tax like it's Facebook ad spend. In all honesty, it's kind of funny. You will bend over backwards to save $100 a day, because that works up to be 30 grand a year in Facebook ad spend. You really will. However, you won't take 1 or 2 days to go and interview financial planners, to meet with your accountant, maybe an extra hour more than you have to go and hunt out a healthcare broker and all this stuff. And in the reality, $100 a day, yeah, sure, it'll save you 35 grand from Facebook, but doing all the things that I'm talking about, if you're making $250,000 to $500,000 a year or more, we could be talking about $100,000 a year in tax savings versus saving 35, 40 grand in Facebook ad spend. So really, treat your tax like you would treat your Facebook ad spend. It's just as important, if not more. Next, get a good accountant. Like, really, really interview accountants. And when I say good accountant, somebody who doesn't charge you through the nose. Our accountant, I think, cost us $1,500 to $2,000 this year. And we have one income property for our personal and our business return. You don't have to get a $5,000 a year accountant. Have a decent bookkeeper. And a good accountant, one, is going to relate to you. They're not just going to, try to put the fear in God and make you think the IRS is going to sue you every day, unless that's your personality type, in which case, by all means. But also a good accountant's going to, you're going to sense when you're pushing too hard, and you don't want to throw up those red flags. Be very, very candid with your accountant, unless you're dabbling in illegal shit, but I'm very, very candid with my accountant. That way you get the best advice. Also, look for an accountant who has quality referrals. Everybody has referrals, but if you start, visiting the financial planners your accountant recommends to you, and they don't seem like absolutely stellar quality, and that might reflect that you have a shitty accountant and might want to keep your eyes open. Last, max your retirement accounts out. In this industry, money comes fast, and it also goes fast. I can't tell you how many marketers I see with high-end cars and gigantic houses that have yet to fund their retirement accounts. And it's astounding, because you see their cars, you see their gigantic houses, you see their big trips all over Facebook. What you don't see is that, whenever they get out of this industry, are these big $1 million accounts, and eventually they downgrade. So pay yourself first before you go and take out the luxuries. So we're 44 minutes in. If you want to cut out now, go for it. If not, I'm going to go through some case studies, and it's going to be about another 3-4 minutes. So let's talk about, we have 3 really quick case studies. Let's talk about Mr. Newbie. Mr. Newbie, he's a brand new IMer. It's in his very first year. He hit the ground running. He found some absolutely awesome products to sell. Made $500,000 after he paid his ad spend, his designers, his employees, and the basic laptop. So basically netted $500K. He didn't write off anything else. He didn't write off his eating out, his entertainment. He didn't write off his car. He didn't try to write off his home office, any of that kind of stuff. He didn't set up any retirement accounts. He only set up a basic LLC. Hey, maybe he's just a sole proprietor, but he's definitely not an S corp. He buys basic health insurance through his state marketplace, and he just buys it outside of the company because he doesn't want to bother with doing it inside the company or figuring out all that shit. He lives in New York, and therefore he's taxed because he doesn't really have any write-offs above his net profits. He's taxed on 500K. So on 500K, he's going to pay 144 to federal. He's in the 39% bracket. And I think we remember from the very beginning of this thing, I think that's like 28.7% is his effective tax rate for Fed. He's going to pay 33K to New York State. He's going to pay a whopping almost 77,000 to self-employment tax, Social Security, and Medicare here. He'll also end up paying $6,000 in property taxes on a very modest home. And he'll pay maybe about $4,000. We're just kind of making this number up a little bit. In sales taxes, all in, he's paying $263K in taxes. Effective tax rate, real money, he's paying 52.6%. He's paying him more in taxes than he actually gets to keep. So that's Mr. Newbie. Now let's talk about Mr. Experience. This guy is tax guru, lives very, very modestly, and like just fucking slams it and says, you know what, I'm going to build a big net worth, and I really don't mind throttling my lifestyle as much as I can to get there. So he also makes 500K, just like the last guy, after employees, ad spend, designers, all that kind of shit. But what he does that Mr. Newbie doesn't is he writes off his home office, he writes off his business entertainment, and he even goes as far to take one extra business trip for fun and a little learning, so he gets an extra $10,000 in write-offs. Also, because he's super smart, he sets up a self-employed 401k for himself and his wife to the tune of a $106,000 write-off. He also sets up defined benefit plan, and oh my god, I'm dyslexic with my writing, to the tune of $206,000 of writing off. Then he sets up an S corp, and he takes a $100,000 distribution. So on paper, this guy claims a $400,000 salary and a $100,000 distribution. Why is his distribution so small, you might be asking? His distribution is so small because this dude has taken $300K plus in write-offs from his business, so he cannot pay federal, state, and self-employment tax on this. This, however, the dividend only protects you from self-employment taxes. Still do it, but if you're talking about whether to take a dividend or doing write-offs and all this, really throw money into your self-employed 401ks. So he takes a $100,000 distribution, so he saves in self-employment tax there. He also goes and buys a high-deductible healthcare plan, right? That costs him $6,000 a year. He sets up a medical reimbursement plan for his wife. Maybe they spent $2,000 on the prescriptions, doctor's visits, that shit. And he also has an HSA, which autocorrect keeps changing to a has. And he goes and slams $6,000 in his HSA for whenever he retires or sells the company, he won't have to pay healthcare. So this all in is $14,000 of write-offs. Moves to Florida, so he's paying zero income tax. Buys a used Mercedes GL 450. Can you tell what car I'm kind of eyeing up for this winter? We'll see. Hopefully. So there's a $25,000 write-off. And therefore, at a $500,000, he's fully taxed on $139,000 after all deductions. So let's see how this shakes out, because he's also going to get some tax savings for his S corp. On the federal, he went from 39.6, which is what Mr. Newbie paid. This guy's in the 25% tax bracket, and he's only paying $22K versus Mr. Newbie, who's paying in the six figures to federal. Mr. Newbie paid $33,000 to New York State. Mr. Experience is paying nothing to the state of Florida. Self-employment tax, Mr. Newbie paid $76,000 because he took no exemptions anywhere. I'm sorry, not exemptions. He took no advanced deductions with his 401ks or any of that kind of stuff. Mr. Experience took $106,000 here, $206,000 there, and had all these additional business expenses. Therefore, he's only taxed on $139,000. But over here, we see that he did a $100,000 distribution, right? Following me? So Because of that, he's only going to be taxed on $39,000 for Social Security and Medicare. Therefore, he's only going to owe $6,000. The difference from Mr. Newbie, who paid over $76,000, Mr. Experience is over $70,000. That's pretty fucking huge. Lastly, his property tax is going to go down a little bit because he moved out of expensive New York and he's in Florida or Nevada or somewhere with low property taxes. Usually when you see lower property taxes, you do see slightly higher sales taxes. So sales taxes went up a little bit. All in, drum roll. The dude is paying $36,000 taxes, still a lot of money, but on $500,000. His effective tax rate, 7.2%. If you're probably looking at this going, holy shit, I could be paying nothing. The one big thing here is this guy made $500,000, but only brought home to mama $140,000. So if you're not really willing to pull your standard of living and all the income back that extreme, we have a Mr. Above Average. So this guy isn't as extreme as Mr. Experienced, but he still does some pretty good tax savings. So this is probably what an average person who implements just one or two suggestions that I'm throwing in this video would kind of expect to see. So he also makes $500,000. He writes off his home office, business, business trip, business entertainment, saves $10,000, sets up a self-employed 401k for himself and his wife, saves $106,000 there. He sets up a basic S corp and takes a $250,000 distribution. Now the reason we're taking a larger distribution is because we're not going as crazy with the business write-offs with the self-employed 401k and defined benefit. We're only doing the self-employed 401k. So instead of going really crazy with a healthcare broker and doing medical reimbursement, HSA and all that, we're just going to do a basic HMO plan, cost $10,000 a year. We're still going to move to Florida for 6 months and a day. And instead of buying, a used Mercedes truck to slam $25,000 off and depreciate it all in this year to be most tax advantage that we possibly could, we're just going to buy a used Audi for not $368,000, for $8,000. It's going to deduct $3,000 the first year. It's going to deduct $5,000 the next year, and $3,000 every year after that. But it's only $8,000, so it'll deduct in 2 years. But $3,000 is going to be this year. So we're going to get taxed on $371,000 after all deductions this year. It's going to shake out. We're going to pay $98,000 to Fed, but still $46,000 less than Mr. Newbie. We're going to pay $0 to state. Mr. Newbie paid $33,000, so you're probably all kind of wincing in your stomach who don't live in one of those 7 states with 0% tax right now. I know I live in New York. That's painful. Self-employment tax, basically it's going to be $121,000. How I got that number is he's taxed on $371 because he did, these write-offs and the self-employed 401k and all that, and he took a $250,000 distribution. So now he's going to pay $19,000 in self-employment tax versus $76,000. Lastly, he's got his property and his sales tax all in. He's looking at paying $125,000, aka 25% of all the money, which is pretty respectable, considering it could have been as bad as Mr. Newbie, who's paying over 50%. But he still has a lot of things he could implement, like Mr. Very Experienced over here, who's paying just 7.2%. This guy right here is like Warren Buffett. Warren Buffett happens to be a billionaire and pays under 15% of his income in taxes. So that's it, guys. Again, I've recapped kind of the best points to touch on, the advanced stuff. Again, I'm not an accountant, but this is a 55-minute roadmap for you to really get some ideas flowing in your head about how to save a shit ton of money in taxes and pay them down the road when you're in a much lower tax bracket or, in a different state, and you won't have to pay any state taxes, and your tax bracket then will be 0. Anyway, getting to the point where I'm kind of rambling. So cool. Thanks for your time. Thanks for hanging in there with me, and take it easy.